2020 was a good year overall. I mean, if you look at the results from all the companies on this panel, I think almost everybody's released now. Net, it was a roller coaster, but it was a good year. We'll talk about specifics, but I think just to kind of put it in context, it'd be interesting to hear from others, but our top rate for the year was 77,000 a day for a 50-day voyage. That, if you capital adjust that to a VLCC, that's about 220,000 a day. So that was a nice peak. The volatility also created opportunities for companies to time charter out at the right time. Some companies were very good at doing that. Others used FFAs to synthetically create that kind of a hedge before the market tipped over. And I think some of the companies that are on the panel that have scrubber-equipped ships did a good job in hedging out their high-low spread. So it was a year of opportunity and an overall good year. We're into a new phase, which we'll talk about in a little bit. So the second point is why did we achieve such peak rates a little less than a year ago now? And I think the one key point to make is that really good markets are built on layers of demand and not just one event. And I think last year was no exception. So as hard as it is to imagine anything prior to the first lockdown in late March of 2020, the fact is that we did have some geopolitical events that started building the tanker market up to good levels in the autumn of 2019. IMO 2020, which was much heralded and discussed on the years prior to its implementation, on January 1st, 2020, it did really build, in particular, demand for product tankers. So by January, as a consequence of that, we were already up into the kind of the high teens. That was also supported by a good winter market. That's something that should never be overlooked. And then when we got into early March, amazingly, the Russians and the Saudis went to war on the price of oil, and that really turbocharged the market. And this was before, the coronavirus had any impact on the market. We then had a bit of a pause around Chinese New Year, when we were all kind of watching with a bit of horror at the spread of the initial spread of the virus. The result, though, was admittedly a demand collapse, but it created this, combined with the price war, an extreme, contango environment that resulted in a lot of cargo movement, a lot of storage opportunities, a lot of port congestion and delays to voyages. So really scrambled up the market, and that created pretty amazing conditions, really through until July. And then when we got into August, the music stopped. And then, in the beginning of that, I think we all thought that on the back of the more, widespread view that we were, probably in for a V-shaped recovery in terms of the global economy, I think we all had reasonably high hopes for the winter market. That did not materialize. We did get a better run in product tankers anyway than we had in kind of September, October, and November. But the market has kind of was more muted, obviously, going through the winter. Having said that, if you go back to starting in December through January and into February, actually product tanker rates got pretty good again. So we were, the East anyway, we were booking freights, TCEs up in the high teens again, right? So I think it's important to kind of differentiate between what's happened to the crude tanker market, and what's happened to the product market. And I think that it's just a result of better underlying demand for products, as well as the fact that we're just more closely linked to economic recovery, which in fact did begin in December initially. So, overall, rather than kind of viewing the last 3 months as being a once in 20-year disaster for product tankers, I think it's been not great, but it's been pretty good overall, and particularly in the East. And I think that kind of lays the groundwork for further discussion with the other panel members around the future. And I think it bodes well for the future in terms of underlying demand.
So, I mean, what we've seen lately, I think, is kind of a reflection that markets, are beginning slowly but surely to normalize. Now, we have admittedly come from very low levels, but, kind of on a more low practical manner, we've seen more exports coming out of China. We've seen more exports coming out of the Middle East. We've seen that there's been a change in ton mile in the West with the cold spell in the US. So products had to move out of Europe for longer distances. So, what you're really seeing is probably primarily the Far East have benefited the most. But when people look at rates, we have to remember also that the oil price and the bunkers have gone up, right? So when you compare time charter earnings now and going back 3 months and 4 months, you have to remember that we have lost a bit in terms of increased fuel costs for the ships. But maybe just to stay a little bit on, I think, on another important topic, and you just mentioned it around time charter and spot market, which is really the sentiment. And, I think the important part to understand now is that when you look at the spot market, one also have to understand where are we on, if you like, the sentiment scale. And if you look at where the industry is right now, you're seeing almost every one of our clients, trading houses, etc., are trying to take ships on time charter. Everyone is on the same side at the moment, realizing that we're seeing a rebound in oil demand after COVID-19 initial lockdown, which has come back quicker than what people expected. And I think it's pretty clear that everyone is expecting a second half of this year to reach the pre-COVID-19 levels. And therefore, people are beginning to look at time charter in. And maybe a bit of confusion, I believe, also on the whole renewable part. I mean, I think when it comes to oil, our view is that we have not passed peak oil yet. And I think you are going to see oil demand go up for the next many years, which means that from where we are sitting now, the normalization that we've seen after COVID-19, I think is going to have a massive impact on the demand side on the back end of this year. Hence the reason why we are positive from that side.
Just look what's happened in the last week between the United States and the United Kingdom. They're bringing forward by months the time that vaccinations are going to be there. And we know from the human behavior that it's going to be instantaneous. The instantaneous increase on gasoline and flying when people are able to get out and do things once they're vaccinated. I mean, all of us in the United States are now getting things that if we have children are getting things on our emails telling us that, activities are back, that lacrosse training is going to happen, that soccer training is going to happen, that, you can go back to doing training, etc., etc. So very soon we're going to be using even more. And, I think that's fantastic. That's the most important thing.
It's very clear that the COVID-19 is, of course, here and now negative for all of us. We're experiencing these low rate environment, but it's really teeing up really well. Demand side, as Robert described, human behavior will be different. But then when we look at how the volumes are going to be moved into these demand areas, then it is a significant change on the refinery side, where especially Australia, New Zealand have closed down the equivalent of capacity that will take somewhere between 35 and 50 MRs to make up for that closure of refinery. But it's not only Australia, New Zealand. We've seen the same acceleration of the refinery closures taking place on US West Coast, US East Coast, also here in Europe and South Africa. So it's really scattered around in the developed economies that refineries is something we don't want in our backyard, you can say. And it's occurring that you got still new refineries coming on in Middle East and in China, in the areas that are already the export areas. So I think the short end of this is that, well, we can't see it in rates now, but as Robert points to, once you got that demand kick, then really you will have an increase in the ton mile demand, even at the same consumption levels that we saw pre-COVID. So of course we need the vaccination roll up. Everything needs to be safe, and it's not only soccer that needs to come back. But once all activity is back in society, we are going to see demand growth on refined products across the mobility and across transportation fuels which will be beneficial, especially with these refinery closures.
To talk about storage, let's start with the really good news, which is on the floating storage, which is obviously the marginal way that petroleum products get stored. It peaked in May of last year, and by the end of February, we're down at least 80% from that peak. So the impact of additional vessels coming off storage contracts and entering the trading fleet is greatly reduced. I think we're well within historical normal levels. We shouldn't see that increased supply further drive down rates as vessels roll off. The shoreside story is a little different. I think it's trending fairly positive. Shoreside product inventories are about 5% higher than they were at this time last year, and call it 4% higher than the 5-year historical average. It's maybe more interesting to think about the days forward cover, which is about 71 days of forward demand cover. That's about 10% higher than the 5-year average. I think that is entirely a factor of demand being depressed, and we should see that number come down pretty rapidly. You know, as we all know, the oil curve is now backward dated, which strongly encourages the drawdown of inventories. And in fact, we've seen inventories come down in most of the OECD markets pretty strongly in the past 6 months. So net, I think, you know, certainly the floating storage, pretty positive. Shoreside storage is beginning to normalize.
Good deal. And to Carlos, obviously the lack of jet fuel demand, nobody flying, that's been a massive overhang on the refined products tanker market. So is this market contingent upon increased air traffic, or can the market recover kind of without the airlines' help?
Yeah, Randy, thanks for that question. It's yeah, I agree with you. It's extremely important, and for us, for this, jet fuel represented 9% of what we transported more or less in 2019. And if we look at the second half of 2020, it was only around 3%. So that gives an idea of the magnitude of the decrease in the jet fuel that we transported. If we look at the industry as a whole, the product tanker industry as a whole, the decrease was maybe less pronounced, around 30%, just over 30%. But it is nonetheless a very important product for us. And therefore, what will happen with jet fuel demand is critical for the overall picture. I think on the tourism side, which is the overwhelming majority of the travel, the business travel, if you look only at number of passengers, represents only around 12% of the overall travel. You're going to see a big rebound. And there's also a lot of personal savings, so which happened because of lack of opportunities to spend. Of course, this is not homogeneously distributed, but there was a lot of excess savings in many countries. And there is this willingness to, human willingness to go out and travel and do the things that people like to do again. And so I think we're going to see a very strong rebound there. And travel will probably air travel will probably return to normal by the middle of 2022. Regarding the business travel, which, as I mentioned, is a much smaller share of the overall travel, there are analysts which say that it could stay at a lower level indefinitely. It will probably continue growing and will rebound, of course, from the very low levels at which we are today. But it could potentially stay at 10 to even maybe 30% below, some analysts say, what we experienced pre-COVID. Now, but if you put that into a bigger picture, it is actually only a small fraction of the overall demand for seaborne transportation of refined products. So even in the worst case scenario where the business travel were to stay 30% below pre-COVID, that would probably only mean that demand is around 0.3% below where it was pre-COVID overall product tanker demand. And the tourist related demand for travel is going to continue increasing. Before COVID, it was expected to more than double between 2019 and 2050, grow at a compounded annual growth rate of 2.6%. So it should go back to that trajectory, and it will more than compensate for the lack of business travel. So I am optimistic on the medium term for the sector, very optimistic. maybe a bit more prudent on the short term. I think that maybe we might have to wait for 2022 to see a stronger market, but I hope I'm wrong. It does. I think it's better to be a bit more prudent, and if we all are not as optimistic as usual, which ship owners tend to be very optimistic, it will hopefully mean less vessels being ordered and an even stronger market later.
And then Robert, scrubbers were all the rage as we entered 2020, but now entering 21, they seem left behind. Not many people are talking about them. Spreads are maybe $100 a ton. Can you provide some updated commentary or thoughts on scrubbers, both at Scorpio Tankers and on the industry level?
Sure, they're great. They're much better to have than not right now. I mean, $100 a ton is, still over $2,500 a day on an LR2. That's great. 700,000 a year. Put that on what's in the normal equity. That's a pretty good return. So, that's all I would really say on it. I don't care if other people put scrubbers in or not. I'm really happy that we've completed our scrubber program, and I'm really happy that the spread's back over 100.
I heard this morning that the CEO of Delta Airlines is much more bullish. He is quoted saying that he expects all of his pilots to be out flying within the next 6 months. So, I mean, let's at least, I think that is positive news, that if he's right, then your expectations are on the conservative side, Carlos. But let's see what happens. Now, coming back to your point, I think in general, ship owners are really good at attracting capital. I would not expect that is going to be, in honesty, currently the predominant restricting factor on getting that order book back up. I think it is regulation and the propulsion system. And our opinion is that the ordering will be thin in the coming years. And yes, there are certain shipyards that definitely will fill slots to keep it at a minimum. But ship owners will, on their side, be hesitant at least somewhere up until the middle of this decade. And I think that's a very unusual situation, of course, that we are in, that we are looking at a market that is primed to come up from the current doldrums. And at the same time, that even when we now come into an upcycle, that I really think there is going to be ordering, but it's going to be marginal. And we're going to, at least in our opinion, not see it reverse to this 15 to 20% of the fleet in the short end.
And then on the other side of the fleet supply equation is scrapping, right? So Kevin, the market seems ripe for demolitions. High scrap steel prices, rising bunker cost, very low rate environment, yet demolition activity remains somewhat limited. I know there's been a few in the recent months, but do you think this changes in the months ahead? Where will there be more scrapping kind of on an industry level with all these older vessels still out there on the water?
Yeah, it's an interesting question, and I think there are definitely a push and pull in the scrapping decision. Let's start off with the positives. 30% of the world's tanker fleet is over 15 years old. I mean, that's an amazing number that I think bodes well for a potential reduction in fleet size in the future. Combine that with the fact that scrap steel prices are surging. They're up easily 20% over last year. If you listen to all of the steel makers' earnings that have been coming up, they expect near historical prices this year, with scrap steel following behind. So I think the economic incentives to scrap will be there. However, just like all of our equities are really a reflection of our future earnings, the scrapping decision is also, a decision that's made with the relatively near-term future in mind. And so for all of the reasons that the panelists have laid out here, I think the future for tankers and product tankers in particular looks pretty exciting for the next, couple years, certainly. So I think when owners are facing that decision, they are taking that into account. When you combine that with the fact that, as Tony said, everybody made money last year, despite the fact that the times have been tough recently. And because not many people ordered, because S&P activity was reduced, most people retained those earnings on their balance sheets. So I don't think you're going to see a lot of financially motivated or companies pushed to scrap. So therefore, you have these two competing factors. I think it's a little bit hard to say what wins out in the end of the day. We've been counseling investors and saying, let's not count on scrapping as being a major driver, but if it happens and we see more than expected, we'll certainly take it.
All right, Robert, question to you. Your board, Scorpio Tankers, recently authorized the 250 million securities purchase program. You've also recently mentioned your shares are trading below NAV. So I guess, what is your outlook on share repurchases versus secondhand acquisitions under the assumption that asset values and net asset values, right, are likely to rise throughout 2021? How do you balance the two?
Okay, I'd just like to take something up on scrapping. In the product market, we don't have to really worry about scrapping, because the beauty with the products is once a vessel sort of gets much older than 15 years old, it effectively has a real, handicap trading in the clean petroleum trade. And that's an amazing advantage that the product market has. So, to get back to that ties into our question. I mean, look, we've got the fleet we want. We've got a modern fleet. We think that the market, other players will consolidate. We applaud Tom's move in the last couple of weeks, applaud Anthony's move in the last couple of weeks. And we also are going to increase the pooling size. Over the next 2-3 weeks, we'll probably add, another 5, 6, 7% pool members to our pools too. And I'm sure that's being the same as being worked in Hafnia and Torm. So this consolidation will happen. For us, we're not going to order new buildings. We're not going to go buy things. Our fleet itself would be the best investment to make. And yes, I think that you've got this real opportunity in the market. I'm glad you mentioned it, but it's not just the cash flows. It's these net asset values right now are almost spring loaded, because the first 10, 20% in asset values off a very quick market is going to come very fast. We've seen how this game is going to be played in the container market and the dry bulk market. Nothing really is different since 2003. 2003, the dry bulk led the product market followed, then the crude market in asset values. So for us, we want to sort of get stuck in as soon as we can, but it's, the correct thing to do first is to get stuck in from a position of strength. When you start to buy back, you want to keep doing that buyback, just like we did in OMI in the 2000s.
Yep.
We were a little patient at the beginning. We didn't necessarily buy back at the lowest price at the beginning, but once we started, we just kept going. And that's the same position we'd like to be in Scorpio Tankers. So we'll wait at the moment. We've said so on the conference call that we'll wait to see the rates cross over to our all-in break-even level. We'd like to see average rates, LR2s, MRs being above $17,000 a day. And then we'll get to it.
Kevin, given the operational exposure at Diamond S, both the crude and refined products tanker markets, which of those do you think recovers first and why? Or are these two segments always going to be highly correlated?
It's our house view that certainly in the intermediate term, the segments are highly correlated, just given the switching at the margin. We do echo, I think, the view of that you heard on the panel today, that we believe products will recover first this time. I think that's not necessarily what you've seen in coming out of past historical bottoms. But I think there are a number of factors, including, as our panelists have described, the permanent closure of refineries in areas that need product, I think will help drag the product market ahead of the crude market in this cycle. So I think appropriate for a product panel, we are very relatively more bullish on products in 2021 than we are on